Why cutting interest rates causes inflation. Do you know that cutting interest rates causes inflation? Hello and welcome back to my channel. Interest rates play a crucial role in shaping an economy. But have you ever wondered why cutting interest rates can lead to inflation? In today's video, we'll break it down in simple terms, using real-world examples and economic principles. Let's dive in. What are interest rates? Interest rates are the cost of borrowing money. When the central bank, like the Federal Reserve in the U.S., adjusts these rates, it directly affects how much it costs businesses and individuals to borrow money. Higher rates make borrowing expensive, while lower rates make it cheaper. The effect of cutting interest rates. When interest rates drop, borrowing becomes more affordable. This encourages businesses to expand and consumers to spend more. Let's break it down. More consumer spending, lower mortgage rates, car loans, and credit card rates mean people have more disposable income. More business investments. Companies can take out cheaper loans to expand operations. Stock market boost. Investors shift their money to stocks since savings accounts offer lower returns. How this leads to inflation. With more money flowing in the economy, demand for goods and services rises. But here's the catch. If supply doesn't keep up, prices start to rise. This is inflation. Example. Think about housing markets. When interest rates drop, more people can afford mortgages. This drives up demand for homes, pushing prices higher. Historical examples. Let's look at some real-life examples. 2008, financial crisis. Aftermath. The Fed cut rates to near zero, boosting spending but also contributing to asset price inflation. 2020 COVID-19 response. Central banks slashed rates, leading to a spending boom and, later, inflation spikes in 2021-2022. The balancing act. Central banks have a tough job. While lower rates stimulate growth, keeping them too low for too long can overheat the economy. That's why policymakers carefully adjust rates to balance growth with stable inflation. Chart shows that inflation range, 2–3%. What happens next? So, what's next? If inflation gets too high, central banks usually raise interest rates to cool things down. But that also means borrowing gets more expensive, slowing down growth. In summary, cutting interest rates fuels spending, which can drive inflation if supply doesn't keep up with demand. It's all about balance. What do you think? Should central banks keep rates low or start increasing them? Let us know in the comments below. Subscribe, like, and comment. What are your final thoughts on the inflation trends?